Hello, everybody. I'm Mike Venuto from Toroso Investments. We're thrilled today to bring to you, in collaboration with Spark Network, the climate think tank. So the ETF think tank and Spark Network have gotten together to help tell the story of the power of pure play climate investments. And we have a wonderful panel of entrepreneurs working in this space that we're going to be introducing today. And I'd like to start out by asking each of them to tell us a little bit about their company and why, or what is their mission statement. So let's go ahead and start with Honeytree. Would you guys care to tell us why you started Honeytree and what it is you do?
Sure. Sure, yeah. So I'm Paula Glick. I'm one of the co-founders, along with Liz Simi of Honeytree. We came together and launched formally in 2018 Honeytree Investment Management. We're based in Toronto, Canada. And one of the things that we launched this business for a few opportunities or a few things that we saw in the marketplace. One was, I grew up in the investment industry and was in the ESG space for 15 years, working a lot with asset owners, asset managers, and saw a lot about how people were thinking about ESG and integrating it, and saw an opportunity to really build out something with an interesting portfolio construction that we've taken, that I learned a lot from Liz and her previous employer, where she learned her portfolio construction, which was a quantamental approach. So it's quant plus fundamental, and that lent very well to ESG. And would allow us to build a product that we felt could really, from a performance perspective, do very well, and at the same time really incorporate a lot of the measures and the considerations that we felt were really important.
All right, Gabby, why don't we come to you and iClima?
Thank you, Mike. Yeah, I'm Gabby Herculano. I'm the CEO and one of the co-founders of iClima Earth. We are a London-based green fintech, and we have a laser focus. We focus on the companies that we think can decarbonize the planet. So we very much lead with E on ESG, and we wanted to shift the narrative. We wanted to focus on the companies that are the direct providers of the solutions that can decarbonize the planet. We wanted to move away from the focus the industry had in the low carbon, the companies doing less harm type of themes. These companies are entering into corporate power purchase agreements, reducing what's called their scope 2, their indirect energy emissions. And that story has its limits. And we wanted to very much show that a very interesting a fund could be put in place if looking at the direct providers of the solutions. So not only we shift the narrative, but we bring something that is unique to the market. We quantify impact.
Hi, this is Linda, a founder and CEO of Purview Investments, and also a co-founder of Women in ETFs. From business perspective, I see the entire economy, the global economy, will be transitioning into a healthier and more sustainable, growth models. Obviously back then, I didn't realize 4 years later, you have major economic blocs who are all doing the same thing with both public support, private investments, and investors' demand for more sustainable economic growth models. In particular, to drastically reduce the carbon footprint that comes from the economy. So the goal of Purview is really to help investors to find a way to design your own carbon offset programs by investing and go behind with companies that are leading the transition into net zero and emission-free world.
We hope you all join us for the Climate Think Tank, the power of pure play climate investments. This was just a preview of all the things that we're going to get into later in the show. This is Mike Venuto. I'm the CIO and co-founder of Toroso Investments, and we're behind the ETF Think Tank. The ETF Think Tank is designed to give lots of information out there to investors and advisors. And we've partnered with Spark Network to bring our network to Spark Network. Lots of networks happening, a big network effect, to talk about climate today. We have a wonderful panel. I know Jim said it was me and the guys, but it's actually me and the gals. We have a panel of some wonderful thought leaders in climate. And there's a lot of other panels going on, although we're on the main stage today. We got lucky, and we're going to get started here in just a minute. Okay, I'm just checking the technical things. It's always new technology. Liz, Paula, Linda, Gabby, can you folks hear me? Ah, there we go. That's what I needed.
Yeah.
All right. And we have one more wonderful thought leader joining in a minute. I know Linda is working through the technology issues, but we're going to go ahead and get started. We had that great teaser section, right, where you kind of gave some thoughts on how you look at things, but I want to go a little bit deeper in the introduction here. And I think, Paula, we'll start with you. I know you shared a little bit about what you folks do at I'll make sure I get it right this time. Honey Tree, right? Yeah, I got it right. All right. Okay. I mean, this is hilarious. In the pre-session, I called it Honeywell, which could not be more of the opposite. Right? So that's why we try to work out the bugs. So Paula, I always love the why question. You know, I know you spoke a little bit about what you are doing at Honey Tree, but I love to hear really why somebody would want to dedicate their life to investing in climate change. I mean, it's got to be more than money. It's got to be a passion. So let's hear about your passion.
Great. Thanks, Mike. It's a good question, obviously extremely relevant for entrepreneurs. Yeah, I can tell our backstory, I guess, from a collective, you know, my perspective. I started in the investment industry. I was working, I had great jobs, some really good experience built up in investment management and operations trading. I worked on the brokerage side, guiding and advising clients. But then I learned about socially responsible investing, and that really excited me. And I literally jumped out of the financial industry to join the world of ESG ratings and ESG research. And I worked for 14 years with two of the world's largest ESG research providers. So I gained a lot of knowledge there. I was really lucky to spend my time talking and educating and also learning with sovereign wealth funds, asset owners, pension plans, foundations, endowments, and also investment managers, advisors, the full spectrum really, on the merits of ESG, why you should be looking at it, how you can consider integrating it. And then I met Liz, who was super excited about ESG, and I realized, you know, we were pretty like-minded, and we had very complementary skill sets. And for me, you know, the opportunity to start my own firm was a coming full circle back into investment management, and at the same time, but now with my ESG expertise. And Liz and I started to look at things, and I'd say there's three main reasons why we started Honey Tree. And the first is we're women, and when we looked at the marketplace, we said, you know, we're the fourth female-founded asset manager in Canada, and when you look on the global scale, really, there's very few female-founded that are actually doing ESG investing or climate change, whatever, anything in this capacity. So it was a unique opportunity for us. The second reason is the gap in the marketplace. And when we looked around, we saw a lot of passive strategies. We saw best of sector. Best of sector often looks a lot like the index. And we saw thematics. So we saw, you know, climate change solutions, gender equity, fossil fuel free, these types of things. But what we didn't see was concentrated active. And really, Liz was trained in quantamental active. And we saw an opportunity there where ESG could mesh really well with a framework. And so we just started to talk about building out what we call responsible growth. And this was a notion that would allow us to find through our framework the most responsibly growing companies in the world. And so Yeah, and the third reason that's connected to that is our portfolio construction. So, we were filling a gap in the marketplace, but at the same time, we didn't see, and I didn't see this in all of my years of talking with folks, that you can take the raw data, the ESG, the climate data, the financial data, and mush it all together on equal footing. And prior to that, and what we've seen a lot in the market is it's a secondary process, it's a siloed team, and here was an opportunity for us to build out a framework that would drive at our understanding of purpose-driven companies, companies that really care not just about products and services, but about how they're managing their broader stakeholders, that they realize, in a sense, it's a virtuous circle, that if you manage your clients well, you manage your employees well, you manage the environment well, it's going to create that feedback loop of better long-term performance and growth.
So I love that. I love the multi-stakeholder approach. I want to take something else you said and bring another one of our panelists up. Let's bring Linda Zhang up, because one of the things you mentioned, Paula, was, there's not a lot of female-owned businesses or investment management businesses at all. What's interesting, and one of the things I love about ETFs, is it's actually a little bit different from the rest of the asset management world. The largest trade organization in ETFs is actually Women in ETFs, which I know Linda was one of the co-founders. So I thought we'd go to her next for the why. Coming off of yours to another thought leader in this climate space. So Linda, we got a little bit of your intro from the teaser session. Let's hear a little bit more about why you decided to become an investment manager focused in climate, and how you see the opportunity.
Okay, can you hear me, Mike?
Yes, we worked it all out. Welcome to the Climate Think Tank. We worked out the tech bugs.
Yeah, well, I have been in asset management industries for many years. 4 years ago, I started Purview for 2 reasons. I think it's, on a personal level, I have a few family members who are affected by pollution-related terminal diseases. So for me, climate crisis and life quality and life itself are intricately linked. And so I want to do something about it through investments. And the other one is business opportunities. In many decades, asset management industries have focused just on risk and return, and they fail to measure the impact on the climate and on humanity, on the communities. And they fail to realize that many industries and companies are facing increasing regulatory risks, and they are also facing being outdated-wise. Technologies and regulations are pushing many industries and companies toward low carbon ways of operating business. So that represents incredible investment opportunities. So that's why Purview is focusing on 2 things: subsidizing low carbon ESG ETFs, as well as providing multi-asset solutions using existing low carbon and technology driven ESG ETFs.
Wonderful. All right, let's bring Gabby up now to talk about the why at iClima a little bit. Thank you very much, Linda. We'll be back to you with some more in a minute. So our next think tanker here on climate, Gabby, tell us your why. Why are you and Shyla doing this?
Yes, our why is decarbonization, Mike. And Shyla and I are both women, and we worked together at G Capital for many years. We both went to Wharton, and we have the background in investment management in private equity. We worked at G Capital underwriting investments predominantly in renewable energy. And we looked at all the solutions that could bring the world to that carbon neutrality, the solutions that could decarbonize the planet. And we realized that 2 things. First is that most of the products in the ETF space, they very much focus on that side, right? The renewable energy, the clean energy only, but it takes so much more for us to get to that carbon neutrality. And that comprehensive set of solutions was not very well represented in the ETF space. So that was problem number one that we wanted to address. And problem number two is this lack of clarity. And we wanted to make a very clear distinction. We're looking at the companies where the revenue is in line with decarbonization. And most of the products in the ETF space, the low carbon products, the companies are reducing their carbon footprint by managing their costs. That's a fundamental difference, right? So you take, for example, Microsoft, Google, Amazon, they are rightly so managing what's called Scope 2, their emissions from indirect emissions from energy sources. So they enter into corporate purchase power agreements with renewable sources and they reduce their Scope 2 emissions. There's a limit to the impact in terms of decarbonization that could come from those efforts, right? So we shift the narrative and we focus on the shovel makers, right? On the companies with products and services that are directly linked to that decarbonization effort. So this is a very exciting group of stories, right? It's the technologies that are converging and enabling that CO2 avoidance. So our why is very much the motivation to bring that concept to market, that the best way to reduce carbon in the atmosphere is by not emitting in the first place. So what are the companies that are moving us away from the business as usual, high carbon intensity solutions, right? Transitioning us to that low carbon, zero emission solutions. Again, very much beyond renewable energy, which is very fundamental, and beyond electric vehicles as well. But we're talking about sustainable products. We're talking about energy efficiency, Internet of Things, allowing us to measure things, smart meters, smart thermostats for us to reduce our consumption, and then some very exciting stories that are not being told. We don't think in a product that is comprehensive. So you take, for example, distributed generation, right? That is a fantastic story. So we're talking about Sunrun epitomizes that concept, right? Of a solar rooftop, right, in a residential installation, combined with some battery storage, right, a power wall, allowing the users, right, the consumers of this solution to be not off the grid, but to be self-sufficient. So you hedge your expenses, right? So that continued trend in terms of retail electricity costs especially in the States, right? You hedge that because you become self-sufficient and you manage that, right? That demand management from that perspective, which is very much powered by the Internet of Things, right? That's a fantastic, exciting story, and no ETF was representing that. So we develop our own benchmarks. We have two that very much represent some of the most exciting trends that we think are out there in terms of the decarbonization, and that is that convergence of technology. In a bit of a dramatic expression that we like is a seismic shift, right? So the world is going to be divided between the companies that are in line with that innovation and the decarbonization, and the companies that are very much in line with the old economy, right? The fossil fuel based type of economy. So we wanted to tell that story. There was nobody else with that focus.
Wonderful. I love when people can articulate the why. I think it's time to go back to Honeytree, and let's bring up, we're going to tag Team Liz up, the other partner. And we're going to move a little bit beyond the whys now and get into data a little bit. So when Paula was describing the background and how you folks got here, there was kind of a distinction between SRI, ESG, and this is really focused on climate. And we're going to get into returns later, but just hearing all the things Gabby was just talking about, most people aren't realizing the Internet of Things has an impact on climate. And I love the theme of themes concept. But to stay a little bit more on the nerdy part first, before we get to more of the exciting part, when we think about ESG, obviously climate is going to fall in the E part. But how should investors be thinking about climate investing is it a satellite to ESG? Is it a replacement for ESG? Should we think of it as another version of ESG? I'd love to hear your thoughts here because, we're all being bombarded with so much information. We saw the terrible BlackRock interview where it's like, hey, we're all just greenwashing, right? We don't want that here, right? So Liz, let's hear your thoughts.
There's a lot of greenwashing in our industry, which I think is why all of us are here, why we all founded our firms. It's not good enough to take, the 5 best oil sands extraction companies and say, because, they're doing some emissions reduction work that they're, changing the world. I think all of us would agree. I think the future is thinking of this ESG data, whether it's climate or workforce, as fundamental company data. Gabby already alluded to how this drives the bottom line, whether you're a consumer or company. If you can reduce your energy costs, if you can reduce your input costs, if you can reduce the amount of recycling you need to pay for, if you can reduce it's all parts of the business. In what's happened in the last decade or so, as things were greenwashed, is it got very narrow. It was about very specific emissions or whatever industry could advertise that they were doing the most work on it. When in fact, there are so many companies in all sectors in the world doing excellent work, whether it is shoes, plastic containers, Internet of Things, shipping, paper, cardboard, you name it. And it's because those companies, whether they are green tech or a traditional industry, not old industry, but a traditional industry, they understand the bottom line impact of the actions that they're taking. They understand that having the energy required to produce a chip saves them buying all that renewable energy, right? And I would just echo, a lot of companies, especially the ones that we'd hear report in North America on this greenwashing ESG stuff, we're not going to solve any climate issues if all the big tech companies just go buy up all the energy from every wind farm and call that net zero and that they're green. It is about reducing travel, business travel, reducing commuting, changing how we do buildings, thinking it's not just about factories spewing emissions in production. And so that's where I think the conversation will be in 5 or 10 years. And you can see it in the leading companies in the world. They are taking climate into account across all parts of their business. They know they have to solve the ocean's plastics problem, and they can't keep on using virgin plastic or virgin materials for everything, because it's not just good for how their stakeholders feel. It's a bottom line. It's a bottom line thing. And that's, I think that's what we all believe, but that's where we know it's going.
Wonderful. Let's bring Linda Zhang back up to talk a little bit more about this data and this ESG. So when thinking about climate, Linda, I know when we did our pre-show, you had some really great data points, right? So I don't want people to miss them here. So I think you know where I'm going. What's your carbon number? When we're thinking climate instead of just ESG, how do we quantify it? How do we look at this data?
Yeah, data is an important part of it, right? It's not the whole part of the story. But when you look at data, you have to measure your portfolio carbon footprint, right? It's almost like measuring a diet. What is the calorie intake, right? When you measure investment impact to climate impact, you gotta measure what's your portfolio's carbon intensity. For example, S&P 500, let's say SPY, right? ETF has a carbon intensity around 160 tons per $1 million revenues, right? With EcoZ that Purview subdivides, we're able to dramatically reduce the carbon intensity by more than 80%. So right now our measurement is 28 versus 160. The way to do that is across industry by industry. We need to look at, who are the companies that are the least polluting companies, right? And who are the companies actually improving on less pollution, more efficient usage of resources such as energy and water, and reducing wastes. So those are the actual numbers that are much more material for tons of industries. For tech companies, they may not have high scope 1 emissions yet. Scope 2, scope 3 that comes from heating and cooling the data centers, company travels, right? These are all very important measurement for carbon emission for tech, even though they're not fossil fuel companies. So data are important, and measuring the portfolio carbon footprint is equally important. So when you talk to clients, what does that mean, reducing in carbon intensity by 80%? We recently did an exercise, right? If you move $1 million away from funds that are tracking S&P 500, the amount of carbon that you achieved by doing this is equivalent to you're driving a standard combustion-based car to the moon and all the way there and halfway back. So that's the power of your personal decarbonization program. And for those, the weather is nice now, that you're probably going out barbecue. So if you have shift $1 million from S&P 500 like products to this very clean ETFs, your equivalent is like $1 million hamburger, flipping $1 million hamburger, the carbon reduced from propane.
We're going to the moon with Elon Musk here. All right. So the way you're describing it reminds me a lot of the traditional way people think about ESG investing, avoiding the bad actors. And I know you go further, but I think I'd like to bring Gabby back up to talk now a little bit about returns, right? So if we obviously look to avoid bad actors, that is one big component. But then there's the other end of it, which we've seen a lot of excitement last year and even at the beginning of this year with the returns that come from the innovators, the companies that are changing the world. And for 50 years, there's been this ridiculous idea that if I invest in anything ESG, I'm giving up returns. We even had Burton Malkiel on one of our ETF think tank shows, and he argued it. I don't know why anyone would do this. I think performance has finally shown that there's more to it than just avoiding. It's about changing. So Gabby, I'd like to hear your thoughts there.
Yeah, I agree, Mike. It's about changing, right? So our key metric is potential avoided emissions in gigatons of CO2 equivalent per year, right? So that is a tangible metric, and that's how we combat greenwashing, is by stating our purpose. And our purpose is to focus on the companies with products and services that are in line with the solutions that are needed, right? A comprehensive approach to all those relevant solutions. And we estimate relevance by that key metric, potential avoided emissions. So moving away from business as usual to the low emission or even zero emission solution. So if we look back, and our hypothesis was very much that putting together these very exciting stories of technology that are converging, right, to solve decarbonization, that we were going to see a lot of growth. We were going to see, of course, that's the story that ARK Invest loves to talk about in terms of Tesla, right? Tesla is not just a automaker. Tesla is an energy company, right? They're going to be a very exciting story in the distributed generation space. So we look back. And we had the hypothesis that you put together this comprehensive set of assumptions, and that there will be a lot of returns, right? Solid performance. And our approach is, it is a passive approach, right? Our view is that as of now, the best way to play this space is a portfolio approach. So don't call winners yet, right? But have exposure to the whole segment. Take, for example, electrolyzers in fuel cells, right? The proxy for the green hydrogen economy. So we represent all the key listed players, right? So Plug Power, Ballard, Nel, ITM Power, they're all in our benchmark. So it's the end approach. I spoke to my compliance before making this point today, and before I get the numbers, and I'm happy to disclose that, she said, make sure that you explain, your audience is familiar, but make sure that you explain that you're talking about benchmarks, right? So we design our equity indices, and we're talking about benchmark figures and in back testing part of that. So if we look back in the last 12 months, our distributed generation benchmark would have been up 307%. And our global decarbonization enablers, so that story of those 157 companies across 28 sectors, would have been up 167%. So that's a lot of growth. And again, it's a passive approach. So of course, it's obvious that we don't have one company, generating all those returns. That's the most exciting story that I've seen, and I've been, in the workforce for the past 25 years. It's that combination of solutions that make economic sense, right? Renewable energy, we are at parity. It makes economic sense. Renewable energy, solar and wind are displacing fossil fuel. Battery costs have gone down to the same amount, about 90% in the last 10 years, right? And we are within 1 year from parity between internal combustion engine and electric vehicles, right? So if we think about that S-shaped curve, if you think about distributed generation as well, even electrolyzers and fuel cells, right? We're at the beginning of that exponential growth. And these solutions, they combine electric vehicles with vehicles to grid, merge with distributed generation, and one thing feeds the other, right? So it's that virtuous cycle that I think Liz was referring to before. That's a very powerful story.
That's wonderful. We're going to get into some more of the things that we see coming in the future in a few minutes, but you just described very much that the returns of your indexes or your benchmarks, and pointed out it's passive, and you're also quite diversified, 150 plus names. Let's bring Paula up, because they have a different approach to get to a similar goal. You folks are active and a little bit more concentrated. So
more concentrated.
Yeah. So let's hear about your approach and how you see the opportunities to not only change the world through climate investing, but also generate returns.
Yeah, so our concentrated portfolio is really trying to identify the 20 most responsibly growing companies. So I would say it's a more diverse approach to understanding firms, but it absolutely includes decarbonization. It includes companies that are transitioning through that low carbon economy, and they can be in many industries. So they're not the solution providers necessarily, although some of our companies are actually creating products that are displacing and disrupting. But a lot of them are the ultimate end users. They are the big, large cap companies that will be, to your point, there might be the offsets and the renewable energy investments, but there's also a very heavy, and this is what we look for, is their commitment to the low carbon economy in terms of their materials that they're using, their operations in their energy efficiency approaches, their energy itself, their water use, their waste. So we're looking at a full package approach to how they're managing their environmental footprint. They are absolutely low carbon, our companies, but our companies are not the per se the renewable energy companies. That's not what we're looking for. We're looking for a more holistic view where you can have a great leader in environmental issues, but they might be very weak on the social side. And for us, we don't want to sacrifice one for the other. So we're looking for a more complete view of, and that's why we call it responsible growth. So we can find those great leaders that have an ultimately very positive impact from an environmental perspective, and they're going to be the purchasers of this supply chain, of these great innovators in some cases. But they also happen to lead on diversity, on decent work, on on managing to all of their stakeholders. But in the environment is definitely core and essential for getting into our consideration set. And as we do that deep dive to better understand, to Linda's point, the varying elements of carbon reduction versus others that might have gotten into the consideration set, we do our deep dive and we can come up with our final 20. So
you get all that. That was going to be my question. You get all the way down to 20.
All the way down to 20, and we start with 9,000.
Wow. And is it across all kinds of geographies, or is there a geography that the data is better and the governance is better to support the overall multi-stakeholder approach?
We are going to skew a little bit inevitably because some of essentially we set very high bars. High bars on the environmental side, high bars on various other. We have some negative screens, so certain industries we just won't invest in. There's certain bars on the diversity front, so we need minimum thresholds, and that's going to knock out just naturally a lot of countries and companies from our. So we can get down to a manageable consideration set pretty quickly. But then, so there's certain sectors that will be avoided, but we're still very diverse. And
20 companies, I don't think that's going to get in the prospectus. But look, yes, high conviction is to go back to the original part of the question. I don't know if you can talk about returns quite because you don't really work from an index, but what should, like, when somebody is investing here in this change, things that can change the world, they're not really trying to get S&P like returns, right? We're trying to participate in the growth of companies that are changing the world.
Yeah, I mean, we absolutely believe that our companies have tremendous impact, but we're about alpha generation, we're about downside capture, we're about quality companies, and we're about companies that are providing that you can have your cake and eat it too. You can feel good about investing in a solid portfolio that is really driving at and not necessarily having those gaps. As I mentioned earlier, you can have great environmental leaders, but they could have really crappy employee practices. They could pay their people pretty badly. They could be treating them poorly. We want to ensure that you have the best of all worlds and that you can know that you're investing in a low carbon strategy that is also doing a lot for its employees and furthermore. And all of that is told through the story of the different data sets and the different components that we look at to determine purpose-driven companies, that they really get it, they really understand it. Our performance has been very good. It's not to the extent that it's not in this, and it's nice to hear that the take up right now, especially now when we're in such an urgency to address climate change, that we had that clean tech bubble many years ago, and so a lot of people were hurt very badly, and there's skepticism, but we don't have time anymore to sort of be questioning, and there is a major drive forward. We believe that the companies we're investing also are part of that solution because they have tens of thousands of employees, if not hundreds of thousands of employees in some cases, and the way they're managing their environmental footprint, again, is going to impact on all these innovators, on all these efficiencies, and it'll really drive things forward in their global operations. And our performance, is in the 30-odd% return, and over 2020, and we were very pleased with that.
All right, so let's bring Linda back up because she's also an active manager in this space, and I know she goes out of her way to make sure to include some of the less covered countries and sectors in the way she approaches it. I don't believe you're quite as concentrated, so I think we've got all the areas of the spectrum. We got 150.
Yeah, I don't have the guts.
We got 150. We got 20. Linda, tell us about where you are and what you expect to see from climate investing going forward as just the investment part. The next question we'll get into the life-changing parts.
So in terms of product construction, we're right in the middle. I confess I don't have the guts of Paula. So we invest in 75 primarily US equity companies that are either low carbon or their climate solutions. So it's across different sectors and investing essentially in primarily industry transition to low carbon economies, including not just renewables and transportations, but also agriculture part of the economy. But we could talk more about it later on.
I'm muted. All right, the tech got me. Let's hear a little bit more about what's in your portfolio and how you approach it. Like, let's just get into something specific. Like, what's one of your favorite names, and what are they doing to change the world here?
Yeah, so one of the, I can tell you there are currently 10 themes. I don't want to go through all 10 themes with
good.
you. Yes.
Let's just pick one or two. Let's not do all 10 though.
Sure. So, theme one is the renewable energies. So we've been in the theme since day one, since our product launch February 28th, a year ago. There are a lot of American companies who are very competitive globally in solar field. We also invest in transportation, electrification transitions. So it's not just Tesla. So we're very happy we invest in Tesla before its 7-fold increase in 2000. We also invest in companies that are involved with batteries, and we also invest in food industry transition to more plant-based. Just because cattle production is a huge contributor to methane because cows do need to burp. There are some interesting trends that I've been following. You can feed actually a seaweed to cows that reduce their burping and enhance the greenhouse emission. But we do invest in some of the plant-based food themes. And in terms of on the social side, I think the biggest story is actually access. Traditional large banks are just not very good at giving equal access to different communities and business of different sizes. And fintech, in particular, mobile payment companies that the U.S. are behind other countries in terms of the mobile payment, but it's quickly catching up. And they have been leveling the competitive landscape across business from large to small. So this is absolutely about increased access problem, access. So that's one of our favorite themes as well.
Wonderful. I want to keep this part of the conversation going. We got about 5 minutes left, so we're going to try and cover the last two concepts rather quickly. So let's bring Gabby back up from iClima, and really quick, just tell us the most exciting thing you see in climate investing and where people can learn more about what you're doing at iClima.
We're very excited about distributed generation. Very excited. It has the potential. If you look at the states, right? We are at the very bottom of that S-shaped curve, right? We are the penetration in terms of the solution that epitomizes that idea of distributed generation, right? We're moving away from that centralized fossil fuel dated industry of long transmission lines, right, to the decentralized energy-based renewable resources, right? So Sunrun epitomizes that concept of that solar rooftop, and right now that penetration in the States in terms of the suitable rooftops is about 3%, and that has the potential to go to 15 to 20% in the next 10 years, right? That's dramatic. And that makes economic sense. So it's not the Californian tree huggers that love the idea of being carbon neutral. It makes economic sense. So it's not a political decision. It's not necessarily driven by your personal view on your desire to decarbonize the planet and contribute towards that. It just makes economic sense. You save money. So with that adoption is just going to we think go through that S-shaped curve. Plus, renewable energy is deflationary, right? Unlike fossil fuel that continues to be inflationary, even more so, right? As we have thankfully less and less investments going towards fossil fuel exploration and production, right? So that trend, right, fossil fuel goes up, renewable energy battery cost continues to trend down, right? That's the Swanson's law that applies to the cost of panels and then also applies to cost of battery solution, right? So it will continue to make more economic sense. And then we have the positive externalities, right? Not only you decarbonize, but then also you help with demand management. So the government and the regulators and even the utilities won't push that back because it's needed. It's needed for us to regulate frequency. It is needed for us to optimize the system, right? So it makes so much sense from an economic perspective, but also all these positive externalities. So we think that this is going to boom.
Okay. And where can people learn more about iClima?
You can check us. We have a very open source approach. We like to talk about our research. It's all on our website, iclima.earth.
Yep. Thank you very much, Gabby. Let's bring Liz up and go over the same perspective for Liz. So what are you most excited about, and where can people learn more about Honeytree?
I'll do the Honeytree thing first. If you're on Twitter, find me because I rant about ESG at Liz Simi, and Honeytree is on there too, but you can check out our website, honeytreeinvest.com, and we've got lots of great information there. So
I've caught you on a couple clubhouses too, which was refreshing because I'm sick of hearing about Bitcoin. So hearing about something else.
Yeah,
go ahead.
I also jump in on ESG or allocator, specifically emerging and diverse manager clubhouses. So I'll make this short. Plastic, avoiding using plastic, doing something with the ocean plastic, making no new plastic products where possible, making everything out of recycled plastic, making clothes out of plastic, making shoes out of plastic, and reducing it all. And I don't think we talk about that enough in the ESG climate world. And I think we see huge changes in packaging and material production and how companies are buying that and using it and driving the innovation. And I think it's just a huge part of emissions and fossil fuel production that folks don't talk about. Everybody thinks it's just gas and cars, when in fact there's so much plastic waste, plastic production, and resulting environmental issues that we can save money by getting free plastic from the ocean to do stuff while cleaning up the earth. It's a win-win.
Wonderful. All right, let's bring Linda up. At the ETF Think Tank, we want to thank Spark Network for working with us here, and this has been a great panel. I'm going to give Linda Zhang the last word, what you're most excited about, and how people can learn more about Purview.
Yeah, I'm very excited that in terms of our industry, we're finally waking up that we cannot call a ETF ESG fund when you invest in fossil fuels. The vast majority of ESG ETF funds today, which is about 60 billion industry now, as I just checked, is full of products with fossil fuels and with dirty electricity companies. So that's not acceptable. I'm very happy that all the panels seems to be presenting an alternative. And I'm very excited about new technologies that continue to push the part of the transition that's the hardest. For example, airlines, right? Fly. How do we fly? Hydrogen could be part of the answer. And again, agricultural, which in the world, it's the second most contributing factor to emission. And there are a lot of new technologies that would replace or complement today's more polluting technology. So I'm very excited for
Wonderful. Where can people learn more about Purview and ECOS?
You can go to my website, purviewinvestments.com. I've published my research, media interviews on the website. Thank you.
Thank you. That's it. Thank you, everyone, for joining the Climate Think Tank with Spark Network's Disruptor 2.0. I do shows at the ETF Think Tank like this every week with my team, so check us out and we'll keep telling the story. Thank you, everyone.